Happy Tuesday to everybody out there. Welcome to the Liberty Call for Tuesday, April 19th, 2022. Hope everyone, like I said, hope everybody's having a great day out there. You can see my puppies lounging over my shoulder there. There's Jake back there by the door, and there's black spot back here is Barney holding down the carpet. So, like I said, hope everybody's having a great day. It's a beautiful day here in Colorado, mostly clear skies, a little hazy. It's probably due to a couple of wildfires we got going on, but nothing too bad. So, all right, well, let's go ahead and jump into things and see how the markets did today. The Dow Jones was up 1.45% today. It was up almost 500 points, closing at 34,911. S&P 500 was up 1.61%, closing at 4462. NASDAQ was up 2.15%, closing at 13,619. Small caps are also up over 2%. The VIX receded 3.61% today. It's sitting at 2137 right now. The other exchanges here in the Americas, Canada was up 0.64. Brazil was down 0.55. Mexico was up 0.91. All right, moving over to Western Europe, nothing but red from what I can see, from Germany all the way down to Austria. The only one that was down more than 1% was Switzerland, down 1.55. But the rest of them, kind of 0.5%, 0.8, nothing too major. Let's see here. Sweden was up 0.25%. Denmark up 1.19. The Russian indexes or exchanges were split. The MOEX was down 1.07. The RTSI was up 0.62. Moving to Eastern Europe, I see a bunch of greens. The only reds I see are Poland and Saudi Arabia. They were down 1.18 and 1.66 respectively. Japan was up 0.69. Australia up 0.56. New Zealand was down 0.7. Let's see. All the Chinese markets were down. The Shanghai was down 0.05. The SESE component was down 0.5%. The China A50 down 0.63. The DJ Shanghai down 0.27, and the Hang Seng down 2.28. Taiwan weighted was up 0.56, and that's kind of mixed for the rest of these smaller ones. So kind of a mixed day. Looks like the Asian markets, for the most part, China being the big guy over in that part of the world, they were mostly down. The smaller indexes or exchanges throughout Eastern Europe appeared to be up. Western Europe appeared to be down, and then here in the Americas, mostly up. So not too bad. Again, don't get too excited about anything because with what the Fed's doing and with the potential slowdown that we're getting ready to see. Buckle up, buckaroos, as what's that character? Bruce Jenner's character on South Park. Not Bruce, Caitlin. I'm sorry. Still Bruce to me. Anyways, all right, let's go ahead and dive into the market recap. Stock market today, Dow rallies on tech strength as earnings season heats up. Let's shrink that down. All right. The Dow racked up gains on Tuesday as dip buyers returned to big tech stocks, shrugging off an ongoing melt up in rates as the quarterly earnings season heats up. Big tech attracted dip buying action to help the broader market close higher. Facebook and Amazon led the move higher, closing at more than 3%. Alphabet, Apple, and Microsoft also ended the day higher. An ongoing rally in Treasury yields saw the 10-year Treasury top 2.9% for the first time since 2018, but that didn't sour sentiment in tech as quarterly earnings came into focus. IBM and Netflix are set to report results after the closing bell. Netflix fell more than 18% in after-hours trade after reporting a decline in subscribers in the first quarter, confounding expectations for a 2.8 million net increase. Netflix will garner most of the attention after dropping more than 40% from its peak. Twitter, meanwhile, remained in the headlines on reports that Apollo Global Management is reportedly weighing up financing a potential takeover offer for the social media company. Johnson & Johnson erased early losses to close nearly 4% higher, despite trimming its profit forecast for the full year and pulling its guidance on COVID vaccine sales following mixed first quarter results. Maybe because those vaccines don't seem to work very well. But that's just my opinion. I'm just one person. Let's see. Consumer discretionary stocks were also in ascendancy, supported by a rally in travel and leisure stocks, including Penn National Gaming, Las Vegas Sands, and Carnival Corporation, as investors looked ahead to pick up in travel demand as the pandemic cools. Airline stocks, including Delta Airlines, United Airlines, American, were also sharply higher after the Transportation Security Administration stopped its mandatory mask rules on planes. Yay! I hate flying. I don't fly very much, but I know I know plenty of people who do like to fly, and they pretty much hated it. So I know there's people out there who say that their magic cloth masks did something. Sure they did. Energy was also the sole sector in the red as oil prices fell for the second straight day amid I'm sorry, I skipped one. Tesla, which ended the session 2% higher, will come under added scrutiny on Wednesday when the electric vehicle maker is set to report quarterly results. Energy was the sole sector in the red as oil prices fell for the second day amid concerns about the impact on energy demand of slowing global growth in the wake of the Russia-Ukraine war. The IMF cut its global growth forecast by 3.6% in both 2022 and 2023 from prior forecasts of 4.4% and 3.8% respectively. In other news, Plug Power jumped more than 9% after its fuel cell company clinched a deal to provide Walmart with liquid green hydrogen power to power the latter forklifts and trucks in its distribution and fulfillment centers. All right, so bunch of news, mostly good. We'll see what happens with Twitter and Mr. Musk. Let's see if he's successful in rooting out all the woke tards that are in there. I know they're really upset that they're going to lose their little play space where they get to pick on everyone else and have no consequences of their actions. But I think that's coming to an end real soon. So, all right. Next article here. U.S. forgives 40,000 student loans, provides aid to millions more. All right. The U.S. Department of Education has canceled student loan debt for 40,000 people and offered credits to help another 3.6 million pay off their loans under a plan announced on Tuesday designed to aid low-income borrowers and public servants. Yeah, because public servants don't get enough free stuff from the people. The measures add to other steps the administration of President Joe Biden has taken to ease the student loan burden, but they stop short of demands from the progressive wing of the Democrat Party for comprehensive student loan forgiveness. The government said it was addressing, quote, historic failures in student loan programs by providing relief to at least 40,000 borrowers under the Public Service Loan Forgiveness Program. Several thousand borrowers with older loans will also receive forgiveness through income-driven repayment forgiveness, plus another 3.6 million borrowers will receive at least 3 years of additional credit towards IDR forgiveness, the Education Department said in a statement. Quote, student loans were never meant to be a life sentence, but it certainly felt that way for borrowers locked out of debt relief they're eligible for, end quote, Education Secretary Miguel Cardona said in a statement. So people are getting bailed out by the taxpayer again. Great. When do taxpayers like me get a bailout? I mean, totaling up everything I've paid to the federal government in the last 22 years, it's like $700,000, I think. When do I get some of that back? I mean, I've been robbed to pay for parasitic type people who live off the government and have government jobs. And when are we going to get something back? You know, I mean, personally, I'm hoping that the federal government collapses and then we can round up all these politicians, seize their assets, sell off government land and live freely again. But hey, I'm just one person. All right. Next article has to do with commodities. Commodity prices are going haywire, prompting fears of a next financial crisis. The prices of commodities, including oil, wheat, and palladium, have surged this year as much as the global economy shakes off the COVID restrictions and as a Russian invasion of Ukraine has led to a key commodity exporting region to be cut off from the rest of the world. Volatility has not only helped fuel levels of inflation not seen in 40 years, market observers are warning that it could put the stability of the global economy at risk unless regulators and central banks wake up to the threats posed. Quote, One after another development related to Ukraine is exposing the longstanding flaws in the increasing obsolete post-Second World War framework of global trade and financial regulation. Kieran Petru, managing partner of the financial policy think tank Federal Financial Analytics, told MarketWatch. Petru argued that the rapidly increasing commodity prices are putting stresses on both commodity traders and the banks and other actors that fund them, and failures to properly regulate these entities could force the Federal Reserve to bail them out, a move that threatens popular backlash. In the aftermath of the financial crisis, regulators debated whether to designate large commodity dealers like Glencore, Trafigura, and Archer Daniels Midland Corporation as systemically important financial institutions, which would subject them to greater regulatory scrutiny, quote, but they didn't have the guts to go there, end quote, Petru said. Recent volatility also underscores the relationship between inflation and financial stability, according to Zoltan Pozar, global head of short-term interest rate strategy at Credit Suisse. Quote, central banks are in love with the idea that they control price stability. He said in a telephone interview, I find it shocking that entities as crucial as to price stability as commodity traders are not more closely overseen by the Fed. Pozar argued that the war in Ukraine will be a turning point in the financial history that will catalyze a partial reversal of globalization and usher in a new monetary order based on the prices of commodities rather than the US dollar. In such a world, the Fed and its counterparts abroad will be unable to ignore the central role played by commodities traders. Quote, these entities that move basic commodities around that you need for industrial activity and price stability, he said, quote, a commodity trader guarantees price stability, not central banks. Regulators are taking notice of these dynamics, even if they are not yet acting on it. The International Monetary Fund cautioned on Tuesday of, quote, severe pressures in commodity financing and derivatives markets, end quote, in its semi-annual report on global financial stability, following the news earlier this month that the U.S. Financial Stability Council was briefed by Commodities Futures Trading Commission and the Federal Reserve on the impact of commodity markets on the financial stability. Wow, those are a lot of organizations that, do they really do anything other than just make our lives miserable? I don't know. Ramit Singh, Assistant Director of IMF's Monetary and Capital Markets, said in a press conference Tuesday that it's probably an opportune time for regulators to study the commodity space to identify gaps in regulation of commodity markets. Dennis Kelleher, President and CEO of the nonpartisan financial reform organization Better Markets, told MarketWatch that there are steps the CFTC could take to stabilize commodity markets, like enforcing stricter position limits on commodity derivative trades that would both reduce the prices for commodities and reduce the risk of financial contagion. A position limit is a control on the number of contracts any one entity can own at any given time in order to prevent excessive speculation and volatility in commodities markets. The CFTC passed new rules on position limits in 2020, as required by the 2010 Dodd-Frank financial reform law, but critics, including current CFTC chairman Rostin Benham, have said these rules don't go far enough. Of course, regulators never think rules go far enough. Quote, commodity speculation is largely unregulated because there is no position limits, or limits are so high that they're meaningless, Kelleher said. These issues are interconnected on the inflation front. Instead of enacting position limits that work, which would bring prices more in line with supply and demand, we have large banks advising clients to shift more of their portfolios into commodities as a so-called inflation hedge, end quote. The CFTC declined to comment for this story. Whether or not regulators decide to change policy in the face of rising volatility, Credit Suisse's Pozar argued that Americans should prepare themselves for a world in which markets for key commodities become a space for geopolitical competition. That likely means that commodity prices will remain a major driver of inflation going forward, and that if the global economy faces another systemic crisis, commodities will be at the center of it. Quote, that's the definition of systemically important, Posner said of commodities dealers. Quote, much like Lehman moved bonds and cash around until it didn't, these companies move commodities around until they don't. So, looks like they're trying to buckle down on the commodities game. So we'll see what happens. I'm personally a person who likes less regulation than more, but you know, governments get what they want, unfortunately. All right, one last article here has to do with retirement planning. JP Morgan says you'll need to replace this much income in retirement. How much of your income will you need to replace in retirement to maintain your current lifestyle? It's a pivotal question, and the answer will serve as a foundational piece of your plan for retirement. After all, you can't set a retirement savings goal without knowing your spending needs. While experts typically recommend replacing 70 to 90% of your pre-retirement income when you stop working, JP Morgan Asset Management has developed more precise targets that are based on your household income. The more money a person makes, the more money a person or family makes prior to retirement, the lower the replacement rate will be. For example, a household with $300,000 in pre-retirement income will need to only replace about 72% of this money through Social Security, employer-sponsored retirement accounts, IRAs, and other sources. At the other end of the spectrum, a family with only $50,000 pre-retirement income will need to replace a far higher percentage, about 94%, according to JP Morgan. Here's a closer look at the financial services firm's guidance. According to JP Morgan's income replacement targets, 80,000 is a key threshold that determines how much of their pre-retirement income retirees need to replace. Those who make under 80,000 will need to plan to replace more than 90% of their earnings with Social Security benefits, withdrawals from 401ks or similar accounts, and other private sources. Households making between 80 and 150,000 should aim to replace between 89 and 80% of their pre-retirement income. The replacement rate drops to the 70th percentile for households making between 150 and 300,000 per year. Here's a look at the specific income replacement targets that JP Morgan Asset Management developed using consumer expenditure survey data from 2016 to 2019 for income and longitudinal Chase data from 2013 to 2020 for spending. So you can see here, starting out at 30,000, you need 98%. Get up to 70,000, you need 92. At 100,000, you need 86% of your income. At 200,000, it's 76%. And above, at 300,000 in pre-retirement income, you need about 72%. Figuring out how much money you'll need on a yearly basis in retirement is the key step in the planning process. Experts generally recommend replacing anywhere between 70 and 90. We already said that. Let's see here. The more a household earns, the lower the income replacement target. The lower the household's pre-retirement income, the higher. Yeah, we already talked about that. So, all right. So, some good little, these are kind of rules of thumb. You can't obviously just expect that this is going to be for everybody, but like I said, it is a good rule of thumb, and that's where working with a financial advisor, you can sit down, go through your spending, today, determine what it might be or forecast what it could be, in 20 or 30 years, and then build a plan to get to that goal as far as how much money you would need to have saved up to actually pay yourself that amount when you're retired. So, all right. Well, that's everything I had for today. Let's see. I didn't even go 20 minutes yet. Wow. I'm really moving fast. All right. So, that's everything I have for today. So if anyone needs anything from me, don't hesitate to reach out. Otherwise, I'll be back tomorrow with Wednesday's Liberty Call. I do have an infusion tomorrow, so I will be a little late. Excuse me, getting back here. And so probably later in the afternoon when I put out my recording. So, but like I said, if anyone needs anything from me or you want to, get in contact with me, you can go to dsafinancialgroup.com. That's D as in David, S as in Sam, A as in Apple, financialgroup.com. All my contact information is there. Or if you want to book a meeting, please do. All right. Well, I hope everyone has a great night, and I'll talk to you tomorrow.